Before you apply for a loan, there's one very important number you need to understand: your debt-to-income ratio. Stick around today and I'm going to show you what it is, how we calculate it, why it's important, and then we'll work through an example together. So what exactly is debt-to-income ratio, or DTI? Simply put, it's a percentage that compares your monthly debt payments to your gross monthly income, or the amount of money you have before taxes and deductions. Lenders look at this number to see how financially stretched you are. The lower your DTI, the more stable you look to a lender. Now, how is it calculated? The formula for the debt-to-income ratio, or DTI, is total monthly debt payments divided by gross monthly income times 100. Easy enough, right? Now let's break it down step by step. Step 1, you need to add up all your monthly debt payments. So, what debt payments do we include in our DTI calculation? These things include a rent or mortgage, car loan payments, credit card payments, the minimum payments, not a credit card balance, student loan payments, personal loan payments, alimony, child support. If you've co-signed a loan with somebody, that could count against you. Any payments like that go into your total monthly debt payments. Things that we don't include in this, like utilities, car insurance payments, your cell phone bill, or health insurance. Even those are expenses you may pay every month, they're not included in the debt-to-income ratio. Step 2, find your gross monthly income. So what's included there? This includes wages, tips, salaries, bonuses, social security, child support, alimony. Things it doesn't include is a side gig, especially if you've only done it for less than 2 years. There needs to be a history of that income. Now, if you're salaried, just take that and divide by 12, and that'll get you your monthly income. Step 3, take your monthly debt payments, divide it by your gross monthly income, and take that times 100 to get a percentage. And that's your DTI. So why does this all matter? Lenders use your debt-to-income ratio to assess risk. If your DTI is too high, it signals that you might be leveraged too much, and a lender might deny you completely or offer you less favorable terms on a loan. Generally speaking, a debt-to-income ratio of 35% or lower is considered very good, while 43% starts to hit the max most lenders will take. Doesn't mean you can't get one if you're a little bit above that, but you might see less favorable terms offered to you in respect to that. All right, now let's bring what we've learned to life with an example. Let's say you're looking to buy a house that's worth $800,000. For simplicity, I'm going to assume that we're going to put 20% down, which is going to be $160,000. That's going to leave us a mortgage of $640,000. We're going to use a 6.5% interest rate on a 30-year fixed mortgage. We're going to give you a principal and interest payment of $4,044. On top of that, let's add property taxes. Now I'm going to use an average in California of 0.73%. It's going to give you $486 a month. Then we're going to add in some homeowners insurance, and we're just going to call it $80 a month. Adding those three numbers up, we're going to come out to $4,610 as a monthly mortgage payment. Now let's consider some buyer's debts. Let's say you have a car payment of about $600 a month. Let's say a student loan payment of $300 a month. And let's say credit card minimum payments are $150 a month. We add these monthly debt payments into our mortgage payment. So it's going to give us total monthly debt expenses of $5,660. Let's say our home buyer or buyers are earning $150,000 or $12,500 monthly in gross income. We can now use these numbers to calculate our DTI. We take $5,660 divided by $12,500, and we take that answer times 100, and that gives us our DTI, 45% in this case. And as we've learned, the DTI of 45% is on the high end. A lender may not even grant them a loan, or they may, but the terms are going to shift. And this highlights why your debt-to-income ratio is so important in the home buying process, and very important for you to understand even before you go and talk to a lender. you can run these calculations at home. And that's the debt to income ratio in a nutshell. It's a very simple yet powerful tool to understand your financial health and prepare for major financial decisions. If you found this video helpful, please give it a thumbs up and hit that subscribe button, and leave a comment down below of any questions you'd like me to answer. See you next time.